Timing the top is one of the hardest things in investing. But what if I told you there's a metric that has repeatedly signaled when Bitcoin is overvalued? A metric so powerful that it has called every major cycle peak in Bitcoin's history. That metric is the realized cap, the godfather of all on chain indicators. And today, we're using 5 charts, all derived from the realized cap, to answer the ultimate question: when should you consider selling Bitcoin? Let's dive in. First up, let's talk about what the realized cap really is. It is a fundamental on chain metric that values Bitcoin based on the price at which each coin last moved, rather than its current market price. Unlike market cap, which simply multiplies the total supply by the current price, realized cap provides a more accurate representation of the network's true capital inflow. It essentially tracks the cost basis of all holders, reflecting the average price at which Bitcoin was last transacted. This makes it a powerful tool for identifying market tops and bottoms. When Bitcoin's price far exceeds its realized cap, it signals potential overvaluation, whereas deep discounts below indicate accumulation opportunities. Now, let's dive into some key metrics derived from the realized cap that help us better understand when Bitcoin might be in danger of topping out. First, we have the realized cap times 4 multiplier. This is one of the simplest yet most effective metrics for spotting market tops. It takes Bitcoin's realized cap, which reflects the total value of all BTC at their last moved price, and multiplies it by 4. Historically, Bitcoin's price has struggled to stay above 4 times its realized cap for long periods, which often signals a market top. This multiplier reflects an overheated market, where the demand to push prices further becomes unsustainable. At the moment, this price is $172,000. If Bitcoin approaches or reaches this level later in the bull market, it serves as a strong signal to consider profit taking. Historically, this has been a level where late-stage investors begin selling, potentially leading to price corrections as selling pressure outweighs demand. Next, we have the true MVRV, a refined version of the classic MVRV ratio, which is derived from the realized cap. The true MVRV corrects for the problem of lost coins, those that haven't moved in over 7 years, and provides a clearer picture of how much profit holders are sitting on relative to the realized cap. The traditional MVRV can often be skewed by old, dormant coins that aren't actively involved in the market. True MVRV focuses on the coins that matter, the ones still in circulation and actively trading. So why is this important? When true MVRV crosses 2.5, Bitcoin has always entered a mania phase, signaling that prices are way above what is justified by the actual capital invested into the network. Every major peak in Bitcoin's history, from the 2013 bull run to the 2021 all-time high, has occurred shortly after this signal. Right now, we're sitting at 1.7. We're clearly not in the mania zone yet, but we are heating up. This suggests that we still have room for growth, but if we approach the 2.5 level, it could be time to start looking for signs of market exhaustion. Now let's talk about the AVIV ratio, which is a fascinating metric that looks at Bitcoin's valuation from the miner perspective. It compares the total revenue miners have earned over time to the realized cap. Miners, unlike retail investors, are the ultimate forced sellers. They need to sell a portion of their Bitcoin to cover operational costs. The AVIV ratio highlights the relationship between Bitcoin's price and the revenue miners are generating from it. When the AVIV ratio enters the red zone, it means Bitcoin is overextended relative to miner revenue. In other words, miners aren't making enough revenue to justify the high price Bitcoin is trading at, which often signals overheating. Currently, we're in the amber zone, suggesting that while the market is warming up and we could still see higher prices, we're not yet in a risky territory. But when this ratio hits the red zone, it could be a clear sign that overvaluation is setting in and the market may be ripe for a correction. If you're finding these on-chain insights valuable and want to stay ahead of the game, hit the like button, subscribe to the channel, and turn on notifications so you never miss an update. Now let's dive back into the analysis. This next metric is crucial, the long-term holder SOPR. The SOPR, or spent output profit ratio, essentially tells us whether Bitcoin is being sold at a profit or loss. Specifically, the long-term holder SOPR focuses on coins that have been held for 155 days or more. In other words, the strong hands. These holders are typically the ones who sell near the top of the market, locking in their profits. In a strong bull market, when the long-term holder SOPR spikes, it flashes a dark green signal and has historically been a sign that long-term holders are cashing out their positions, typically signaling that the market is nearing the peak. When you see this indicator spiking while Bitcoin is hitting new highs, history suggests it's time to de-risk your position. The smart money is likely exiting, and if the market starts to turn, these holders will probably lead the way down. And finally, we have the long-term holder realized profit and loss. This metric measures the percentage of profit long-term holders are realizing when they sell their Bitcoin. Typically, long-term holders only sell when they're sitting on massive gains, usually at least 500%, but it can often go much higher. For example, in the 2017 cycle, long-term holders locked in over 3,500% profits at the top. In 2021, this number was just over 1,200%. Currently, we're sitting at around 300%. While this is still impressive, we're nowhere near the profit-taking levels seen at the top of previous cycles. Once this metric spikes and long-term holders start realizing gains of 500% plus, it is a clear indication that the market may be approaching the end of the cycle. That's when you'll start to see smart money moving out and retail investors potentially left holding the bag. So, to wrap things up, looking at the combination of these metrics, we can conclude that Bitcoin is not in the danger zone just yet, but we are getting close. The realized cap is a crucial metric for understanding the true value of Bitcoin. When the market price significantly surpasses it, it often points to overvaluation, signaling that the market may be overheated and a peak could be near. It's a good time to think about taking profits before a potential correction. Another thing to consider is when Bitcoin's price is detached from the capital that's actually flowed into the network. This discrepancy suggests that speculation may be driving the price too high, and a reversal could be imminent. Finally, when long-term holders start realizing profits, it's typically a sign that the market is nearing its peak. These holders usually sell near the top, so when we see them locking in gains, it can be a strong signal that the cycle is coming to an end. And that's all for today's analysis. Want more in-depth insights on today's topic? If you prefer written content, join my free newsletter for exclusive analysis. Click the link in the description. Thanks for tuning in, and I'll see you in the next one.